I think we are coming off a high inflationary environment. Right now, it's a fact that the inflation has eased off substantially and it is well within RBI's targeted reference range. That means RBI would obviously be comfortable with the rates being lower than what they were. Possibly over the next couple of years, rates should go substantially lower than the present rates. Obviously, a lot depend also on the global factors and how inflation is going to shape up globally, because a lot is happening with respect to geopolitics at this point of time. We understand how the markets are reacting to the trade war that has broken out. We also understand that markets should be gearing up for a high inflationary environment even going forward. However, having said that, I think India is largely insulated from a lot of things thanks to the consumption of 1.5 billion of population. We are inward looking economy with very less dependence on exports, and the crude oil having crashed because of whatever is happening only augurs very well for India, because India is a crude importing nation, and lower crude prices would mean that the inflation would be more manageable. An expansive monetary policy possibly would be in the cards. The rates that have been lowered right now in the recent RBI's policy meet is just the beginning of many more rate cuts. I do not want to predict how many rate cuts we would see in this given calendar year or this given financial year, because as I told you, a lot is changing very fast at this point of time in the global scheme of things. So we have to wait and watch what the other central banks are doing, how inflation is hitting the developed economies, and obviously RBI also needs to be in sync with the rest of the central banks. That point has to be understood very well before trying to predict the number of rate cuts or the quantum of the rate cuts. To reiterate what I said earlier, lower interest cost is in the cards, and going forward we will possibly see lower and lower interest rates unless the inflation balloons and goes to the roof again. If the inflation is in control, we will have a expansionary monetary policy. That means the liquidity should ease, provided of course the government is not under the pressure of the currency, of managing the currency. That means that the rupee remains stable or the rupee weakens at a rate that is manageable. So, if those scenarios persist, I think we are easily looking at a liquidity push by the central bank. I think we had a fantastic last term of Mr. Shaktikanta Das, but in the last 1 year of his tenure, he sucked out a lot of liquidity from the markets, possibly because of the high inflationary environment or the fear of inflation going out of control. The present governor, of course, Mr. Malhotra, has already released a lot of liquidity in the banking system, and sooner or later we will see the credit offtake happening if the rates keep going down and the banks are encouraged to start lending back aggressively. That would in turn have a cascading effect on capex, on investments, on consumption, everything. So lower interest cost, if the inflation is within RBI's targeted range, is going to fuel the economy towards the right direction, and we will likely see the economy or the economic growth being around that 7% mark. That is what is the expected GDP growth rate for India, optimistically, in the longer period of time.